Good morning, everyone. This is working, right? Actually, it's working now. I can hear myself coming back. Excellent. I was like, good morning. Just again, quickly, I'm Kevin Carmichael, economics columnist and editor-at-large at The Logic. And I'll introduce my panel quickly. A lot to cover in half an hour, and my experience tells me half hour sort of feels like 5 minutes, so we'll get to it quick. So down at the far end, Naga Parvatharajan, CEO of Ratehub. Sitting next to me is Bill Johnston, Senior Vice President, Product and Innovation at Equifax. And then in the middle, Bob Dugan, Chief Economist at CMHC. Thanks, guys, for coming to do this. So look, this panel is about risk. That means there's only one place to start a panel on risk on a morning like this. Naga, a lot of your career was based in the U.S., so I'm going to pitch to you first. Tell me how you're thinking about the election results this morning. What is that? How are you incorporating that into your thinking? And you can take that any way you want. Gary likes spice, so if you want to get spicy off the top, please do. But really, I think probably the audience is curious about how you incorporate a shock like that or a potential shock like that into basically your planning going forward.
Absolutely. First of all, thank you. Thanks for having me on the panel. I can't say I'm an expert on Canada. I've only been exposed to Canada for the last 4 or 5 months, my first gig outside of the US. Was there an election yesterday? Were we surprised? I don't know. There's two angles here. There's risk and then there's elections. I'll take both parts. And I would say, listen, I'll quote my first CEO who said, risk is the business. Risk is not a function. And we're all risk managers. So we should be thinking about risks all the time. So that's point number one. Point number two, with respect to elections, this is a great panel. You've got an economist, an operator, CEO, and a technology partner. You could write a lot of jokes with the three of us walking into a bar. Point being, you're going to get a lot of maybe opinions on what's going to happen to the rate environment, delinquencies, losses, et cetera, et cetera. It's kind of a little bit of a wait-and-watch mode. I personally think it's a little bit of you put all this in a blender between increasing tariffs, coming up, rate cuts. What does all that mean for the purchase market in Canada with respect to housing, with respect to rate environment and borrowing costs in the US? It's hard to say where all this is going to land. And that's honestly my opinion. And I'd love to see what The Economist has to say about it. So it's going to be a little bit of wait on the sidelines, see what happens. But I think there will be a few rate cuts as expected in the first half. The question is what happens in the second half and what does Trump do with respect to tariffs and with Elon Musk getting involved with a lot of the government spending cuts and things like that. And how does all that sort of, when you put that in a blender, what kind of outcome do you get is anybody's guess.
Are you one of those who takes Trump seriously or literally?
Oh, my God, you're on fire. You have to take him seriously. He's won 2 elections, having lost 1. So you can't ignore him. You may like him or hate him. That's your politics. But you can't ignore him. You have to take him seriously. That's my personal opinion. He's done a few things to, again, say any conservative government is going to be light on regulations. The financial markets today are going to be on fire. So that's always good in some way. It's going to propel some growth, at least in my opinion. The rest of it comes down to there's also a Fed meeting happening this week, so it'll be interesting to see the minutes of that meeting and whether they're going to lean in and is there a rate cut happening in the near future. I think there's a 67% chance of a rate cut that is projected at least in the forward curve. So, yeah, we'll see.
Okay, let's turn to The Economist. Bob, after this, you going to rewrite your forecasts, or how are you interpreting what's happened?
Well, we're going to have to rewrite our forecast for a number of reasons, this being one of them, of course. And I think when you say wait and see, there's a lot to sort through, actually. So the tariffs is one thing that's going to affect, the terms that Canada trades with the U.S., but with deregulation, lower corporate taxes, the U.S. economy is set to maybe grow more quickly than we otherwise would have forecast. So maybe we have a smaller share of a faster growing pie. And so we have to sort all that out for sure going forward. I'm worried about other things like, the changes to the immigration rules that'll affect population growth next year and what does that do to the economy. So there's a whole slew of things that are going to make me revisit my forecast. and also the fact that the Bank of Canada has been cutting rates more aggressively than we thought. If you go back 6 months, we're probably about 3 or 4 months ahead of the schedule that we thought they were going to cut on with where we're at today. And so all these things are going to factor into our outlook for the economy, but also for the housing market over the next year or so.
The previous Trump presidency brought a shock of uncertainty, if I can put it that way. We saw business investment essentially freeze in Canada. Are you anticipating that same sort of reaction this time, Bob, when you sit down to rework your forecast, or has the context changed?
One thing that the lower corporate tax, so, again, if we're taking Trump literally and what he says he's going to do, the cuts to corporate tax rates are going to create a fairly big gap between Canada and the U.S., so that could really have an impact on where businesses decide to locate and what kind of investment we see. So what does that mean? I guess in Canada we'll have to look at that and maybe react and do something on that front as well. But that certainly poses risk to our corporate investment here. And, ultimately in a country where we have a productivity problem, Canada's got a very low productivity rate. If we don't get the investment, that's going to persist, and that's going to limit our long-term GDP growth potential. But it also, I work at CMHC, we care about housing. When you have low productivity growth, that limits the amount of income growth that you can get without causing inflation. And income is a denominator when you talk about affordability. And so without that productivity growth, because of business investment, it limits income growth, and it makes the job of getting more affordability in housing more difficult to get at.
Okay, Bill, your turn. How are you thinking about all this? What can you add to this discussion?
So first off, I will not be blamed. I was in Atlanta in 2016 and last night, and it is not my fault that he was elected, but I did seem to be his rabbit foot. I think the question will really be about the impact on the Fed. So if he goes expansionary, if there's sort of lower corporate taxes, and we see a real ignite into the U.S. economy and the Fed has to slow down. We saw there was a 50 basis point cut by the Bank of Canada last time, but the Canadian dollar is down over 3% in October. So they're starting to factor in that spread against the U.S. They feel like the Fed's only going to go 25 points this week. So if the Fed starts to slow down, it's going to start to tie the hand of the Bank of Canada. And so to me, that's where the risk starts to come in. If he's able to act fairly quickly, do we just see a slowdown in our rate cuts because the Fed's going to be on hold, wanting to see what he wants to do?
All right. So, Bob, let's bring this conversation back to you. Come down a few thousand feet, get a little closer to what's going on in Canada, and talk a bit about, I guess we'll start with the trajectory of interest rates. What do you see happening from here? I mean, what sort of path do you think the Bank of Canada is on?
Well, clearly the Bank of Canada is going to continue to cut rates. I mean, right now the bank rate's at 3.75%. Our estimate of the neutral rate is close to 2.5%. So the neutral rate is where interest rates have to get to so that we're no longer holding back the economy, but we're not stimulating it either. So we have 125 basis points to go. And so we see short-term rates coming down, between now and probably the middle of next year when they get to that 2.5% neutral rate. A lot of people, though, when you think about longer-term mortgage rates, so we've had 125 basis points of cuts by the Bank of Canada. Five-year Government of Canada bonds are down about 140 basis points from their peak. So they've moved by more than short-term rates have. And this is really reflected in five-year, mortgage rates as well, which have come down quite a bit already. Not posted rates; they've stayed fairly sticky. But when you think about the discounted five-year rates, they've come down a fair bit by more than the Bank of Canada cuts so far. So in other words, I think the Bank of Canada cuts are largely priced into the longer-term rates already. And as we continue to see short-term rates come down, variable rate mortgages will come down a little more. But I don't know that there's much more room for five-year mortgage rates to come down. And so folks that are thinking, wait and I'll get a better rate in 3, 4, 5 months' time, I don't think it's going to happen. We've got a very flat yield curve in Canada. It was negative up until recently. Now we've got about a 20 basis point difference between the 10-year and the 2-year Government of Canada bond. A more normal slope is about 100 to 150 basis points. So as the Bank of Canada continues to cut, I think short rates will come down, long rates will stay where we are, and we'll see a more normal slope of the yield curve coming our way over the next, year or so.
Naga, how does that fit with what you see happening with the trajectory of interest rates? Must matter a lot for your business.
Yeah, and for those of you that don't know Ratehub, more than 70% of our revenue comes from mortgages. We are a one-stop shop for all financial needs: save, spend, borrow, invest, protect. We have the lowest mortgage rates in Canada, in case you're in the market. But speaking of mortgages, obviously, listen, we watch interest rates like a hawk in terms of what's going on. I think the rate cuts have been helpful. We have seen some green shoots in the market. Purchase activity has picked up. Is it at the levels of, say, 2021, 22, which was sort of the peak of the market, NFW? I think there will be more activity in 2025 for sure as the rate cuts come in, and I'm sure there's a lot of people waiting on the sidelines to see sort of where this lands. I think that there's a fine line between window shopping and actually taking action. So I think you'll see a lot more window shoppers taking action in 2025. That's definitely going to happen. How much, time will tell. We also know there's a big renewals uptick that's awaiting. 1.2 million fixed rate mortgages are up for renewals in 2025. That's a huge TAM. So it's not a secret. And the question is, a lot of those mortgages were locked in when the Bank of Canada rate was, sub 1%. And the question is, so it's going to be a big boost in terms of the payment and the interest rate that these loans will renew into or switch into. So it'll be interesting to see how all that plays out in 2025. So definitely purchase market will be better, in my opinion, compared to 2024. And the big race to renewals and who can take a big share of that 1.2 million mortgages that are up for renewal, that's going to determine how well 2025 mortgage plays out for everybody, including Ratehub and everybody else in this room.
Bill, what are you seeing about, what are you seeing from your vantage point? I guess the more specific question is, how do you think households, businesses have held up during this period of, I guess, first the spike in inflation and then higher interest rates and lots of fears of waves of bankruptcies, defaults, that sort of thing? We haven't really seen that, I don't think. Maybe your data says something else, and if it does, you certainly share that with us, please. But just what's your general state of just how the households and businesses have held up, and if they're primed to take advantage of a lower interest rate environment?
So I think there's a couple of aspects. So I think we've held up fairly well. If we compare back to 2017, 2018, when rates went up, 125 basis points, we saw more movement in the market than we've seen with these big rate hikes. Now, part of what we've seen, though, is we all expected it to be mortgage people, right? Mortgages, large mortgages, rates go up, I'm going to get in trouble. But the good news is the renewal process was actually related back to when the mortgage stress test came in. So actually, the renewal volume's been relatively low, coming in from higher rates. So the renewal process has been okay. We see mortgage holders are performing very well. There's weakening, but they're not really, really bad. Where we're seeing a bigger challenge is people who are not mortgages, renters, where cost of living is having a bigger impact. It's not really about the rates. So lower rates won't help that population. The one thing we do think will help in the marketplace, though, as rates went up, we've calculated about $200 billion in excess savings in the Canadian economy, mostly held by the top 25% of incomes. But a lot of that money moved into fixed things like GICs in particular. As those GICs come to term, that cash will come back into the market. So I think you've got a situation where we agree with Bob. Actually, mortgage rates might be as good as they're going to get in this cycle. I got a bunch of excess cash coming back. So we think mortgage and housing will do really well. But this sort of non-mortgage group, these renters, the young borrowers, we are going to start to continue to see some weakness there. And that's why consumer proposals in particular have really skyrocketed through the last little while. And a lot of that's relating back to people who don't have mortgages. They're not homeowners, and they're just struggling with cost of living. So interest rates won't really help them, but we do think there's this other population that will benefit and really start spending that excess cash.
Do you worry much about, the zombie company? I suppose we could say in this case the zombie mortgage holder have been, they've gotten a lot of help from their lenders, sort of stringing them along, stretching out the amortization period through all of this. Is that something to worry about, or is that just the market sort of, taking care of itself?
We do have concerns around mortgage renewals. So the good news is, like I said, it's going to be a pretty big spike starting mid-25, we're going to see a real acceleration in mortgage renewals, a lot of them coming in at 2% or sub 2% mortgage rates. So we do think that there will still be a challenge. The Bank of Canada coming down will help. It's probably still a 200 or 300 basis point increase in their mortgage rate. But what are you going to do about all these variable rates who have not been paying down their principal balance? So you're going to have to extend amortization or you're going to have a much higher payment. So I do still think the mortgage renewal cliff is going to be a challenge, but primarily about how am I going to deal with sort of this excess balance. So I do think that's still a challenge we're going to face next year.
Okay. Bob, talk a bit about the chance of a sort of revival of consumption, household consumption going forward. There is money sitting in the GICs, as was mentioned. The savings rates are high. Although there's the mortgage cliff that I know that you mentioned earlier. Pull all that together and just sort of give a lay of the land of how you see sort of the demand impulse over the next year or so.
Sure. And maybe I'll just drop a plug. I mean, you plugged your interest rates. I think some of the numbers you were quoting were from our report yesterday, where we were talking about the 1.2 million mortgages that are fixed rate mortgages.
My homework.
Oh, there you go. You didn't source this, though. Anyway, 1.2 million mortgages up for renewal next year. And as you mentioned, about 85% of those mortgages were contracted back when the Bank of Canada policy rate was below 1%. So, good report. Have a look. We published that yesterday. But what that means is we do expect a lot of consumers are going to have to tighten their belts. And so when they renew those mortgages at higher rates, I think I agree with you. I don't really expect a big increase in mortgage arrears. I mean, they have come up a little bit, but usually, mortgage arrears aren't really that correlated with interest rate increases. It's more unemployment that's going to drive that. So, mortgage arrears have increased from about 0.14%, a couple of years back. They're 0.19%. Prior to the pandemic, they averaged, somewhere around 0.3%. Very low compared to, say, numbers we used to hear in the U.S. during the financial crisis, when it was closer to 10%. So we're seeing very low numbers in Canada. Interest rates are coming down on the margin, so the Bank of Canada is cutting, but for a lot of households, effectively, interest rates are still going up because of that mortgage renewal that'll take place at higher rates. So we don't see much by way of mortgage arrears increasing, but we are seeing the stress in other arrears. So like when you look at credit card arrears or auto loan arrears, they've come up. And so we're seeing stress on household budgets because of higher interest rate payments. And that's one of the key reasons why we're a little more pessimistic about the forecast than some other forecasters. A lot of people are expecting GDP growth of about 2% next year. We think it'll be closer to 1.5%, and a lot of that has to do with the fact that consumers aren't going to be able to spend as much. Yes, they have savings, but some of that's going to go to higher debt service costs. A lot of the savings, as you mentioned, is held by the top 25% of income earners. A lot of these folks don't have mortgages anyway, and so a lot of the people that are carrying debt have lower levels of savings, and these folks are going to be forced to, deal with higher interest rates and higher debt servicing costs over the next several years as they renew at higher rates. So that's my big worry or one of the key reasons why we're pessimistic about growth in the economy.
Do you think that the Bank of Canada gets its soft landing? Is that secure, or do you worry that we might skid off the track here?
I got burnt so many times calling for a recession over the last year. And, one of the things that saved us from that recession, honestly, has been population growth. And last year, the population grew by the strongest rate since 1957. It was 3.2% growth. And that really kept the economy growing because all those new people that come here, they have to eat and they need to buy stuff. But when you adjust for that and look on a per capita basis, we've actually been in a per capita recession in Canada. So that's how I justify my call sort of thing. It has been a very weak and sluggish economy. There are definitely risks going ahead. I talked about some of them earlier. So there's the burden on consumers of having to allocate more of their disposable income to debt service. But there's also the fact that the population is set to decline next year. The estimates are about a 0.2% decline as a result of some of the changes to non-permanent residents and to immigration next year. And so with all that, there is a risk of, the economy actually not being a soft landing and having a bit of a bumpy landing instead. I haven't worked all that out in our numbers yet. We're starting a new forecast process, but we'll have to consider all these things as we go forward.
Naga, I'm curious about what you think about the soft landing narrative, one. And two, talk to us a bit about how you're sort of setting up for the year, the 2 years ahead, from the vantage point of Ratehub. You've got a business to run, you got a profit margin to maintain or expand, I assume. So how does one do that in given what you see on the horizon?
Yeah, I mean, great question. And unlike the Economist, I'm going to be an eternal optimist. So I do believe it'll be a soft landing and then maybe even a bit more of a growth environment, I would say, in 2025. And I'm a big believer in success is setting ambitious goals and just falling short of those versus failure could be setting achievable goals and exceeding them. So we've set ambitious goals at Ratehub. Like I said, we're changing the value proposition. We want to be the one-stop shop for all financial needs of the consumer: save, spend, borrow, invest, protect. We have a thriving mortgage business, a thriving insurance business. We've got credit cards, loans, and there's more products coming. I can't talk much about it, but so we're investing. We're investing in growth. We're investing in data and technology. 10 years ago, I said in a panel in the U.S. When I was at Goldman Sachs, I said, consumer centricity is the future of banking. And today I'll say the future is now. Consumer centricity will continue to be the present and the future of banking and financial services. And data and technology will be the means to consumer centricity. And that's what we believe in at Ratehub. We want to keep the consumer at the center of it and do what's best in solving problems for them. They have pain points, they have financial needs, and we're here to meet all those financial needs with our one-stop shop value proposition. So one, we're investing in growth. Two, we're very optimistic about 2025. Will we get punched in the face? Yes. We have a plan, but we will counterpunch and we'll come our way through. And I believe 25, at least the second half of 2025, I do believe there will be quite a bit of growth, in my opinion, and that will set us up for the next couple of years. So that's at least the forward-looking view from a Ratehub operator perspective.
What is it precisely that drives the impulse to invest? What drew you to take the position that you've taken at Ratehub? One, what the Ratehub's owners like? What's the thing? What's the one thing that said, you know what, this is time for us to invest? We have an opportunity here.
Yeah, and maybe I'll go a little bit into my background. I was a banker all my life, Capital One, Discover, then joined a bank called Goldman Sachs, launched their consumer retail banking division, and then last 6 years at SoFi, running their biggest P&Ls, credit cards, loans, etc., took them public. Point is, in many ways, I see the Canadian fintech ecosystem perhaps at a similar spot to where maybe the US banking ecosystem was in 2011, 2012. And the last 12 years, we've seen the so-called fintech boom in the US, and I'm blessed to be part of that journey. My journey has been the fintech journey in the US, and in a lot of ways, I saw those similarities. And Ratehub had all of the ingredients for us to become that one-stop shop. I don't see, with a lot of humility, I say this, I don't see a lot of players who can do that, because we have an insurance business, a mortgage business, we've launched cards, loans, and we can all want to be that, but you've got to have the right ingredients to sort of create that one-stop shop, super app kind of a strategy. And that's what attracted me to leave SoFi and take Ratehub. And that's one of the reasons why I'm very optimistic about both the ecosystem, the market, the consumer centricity that can actually win the market in Canada. There are differences, but it's not too different from what the US was in 2011-12. It's, fewer banks dominating the Canadian market, and fintechs, in my mind, are partners to banks, not competing with banks. And superpowers sometimes can be turning ors into ands. And so I look at the fintech ecosystem as how do we make consumers make financial decisions better, reduce the cost of capital, and how do we partner with the banks? The banks have balance sheets, lower cost of capital. The fintechs cannot compete with that. We can't take an axe to a gunfight. So we've got to play to our strengths and win and sort of create value propositions that are sustainable through the cycle, that are resilient through the cycle. So a lot of those reasons is why I took this job, and I took a 6-hour flight and a 3-hour time difference. I still live in San Francisco. So I wake up every morning at 4 o'clock, start calls at 6 a.m. But that's what sort of motivates me to do it, because I'm very optimistic about the future of Ratehub and the future of Canadian fintech and banking ecosystem.
Bill, inflation has come back. We've learned that interest rates can, in fact, spike again. These things we were supposed to have conquered both up till a few years ago. What have you learned throughout this period from the Equifax vantage point or perspective?
Yeah, a couple of different things. So we talked about soft landing. I mean, it's a misnomer, right? So if I'm in the top 25% of income, it's a soft landing. It's great. There's a whole bunch of people. It's not a soft landing. It is a hard landing. So we are seeing delinquency rise. We're seeing it start to accelerate. And so I think there's a lot of people out there. And I think we got into a world where we thought interest rates only went one way, and that was down. And so I think what we're seeing is people reacting to that. And one of the measures that we use is we look at the percentage of people who are paying their credit card in full every single month, right? So it's just an indication of cash flow. And we saw it in 2017, 2018 when interest rates went up, and we saw it again now. If I'm a home equity line of credit user and I've got $75,000 balance, my payment went up, and it went up right away. Mm-hmm. And what we see is a significant portion of them no longer pay their credit card in full. So what happens, I'm going to pay my home equity line payment, and I'm just going to let my balance grow on my credit card. So you see how people have to start making these cash flow decisions. And so I think we came from a world where inflation really was benign for the longest time, and I was an economist, and I remember being with John Crow when he was the Bank of Canada governor, and it was this whole idea, and I think we've got into a comfort zone where they're always going to be low. And we've seen can be immediate shocks to the system that fundamentally change the underlying fundamentals. And that's really what COVID did. That's what supply chains did. They really changed that inflation thing. And I think the reality is it was always going to correct on its own in a way anyways. But we've realized that we don't have as much control. And so we just have to be good sort of credit managers, money managers, because you just don't know. I think that's where we just saw that immediate change that we hadn't really seen in the marketplace in quite a long time.
Okay, we're 3 minutes left. I think I'll give each of you a chance to leave a parting word, maybe responding to this question. I mean, to Bill's point, I mean, it has, history caught up with us. We've got a lot to think about now. I think anybody who tries to cast forward a few years. Naga, I'll start with you. What's your big learning from the past few years that you're going to sort of work into your thinking about how to take Ratehub over the next little while? And I'll give similar questions to each of you down the line.
Yeah, I think I'm in Canada, so I'll say this. You've got to go where the puck is going, not stay where the puck is. I think that's the crux of running an evolving business. What was like chatbots were a big deal in November 2023 when Sam Altman released ChatGPT, and in November 2024, it looks like a decade-old technology already, right? And I know there's an AI session going on in parallel. Point is, the market is evolving, the technology is evolving, and so will the consumer. I think a lot of what I hear every day is, the Canadian consumer still likes to sort of stick to old habits, talk to a human. Yes, they would love to talk to a human, but if we can take friction out of the experiences by leveraging technology, by leveraging data, you can never lose if you can differentiate on fast selection, content, convenience, and value. If you can deliver 2 out of these 5 things, you're in the game. If you can deliver 3 out of these 5 things, you're actually winning something. And these are all learnings that I think I've got through just experience, and I do believe the market is ready for those kinds of experiences to come in and partner with the banks and remove friction from the existing experiences. And if you can deliver, like I said, 3 out of those 5 values, I think you can create differentiation and disruption. And the market is ready for the change, and the consumer will adapt. And I live in the Silicon Valley. The saying goes, you build it and they'll come. I have a slightly different view. You build it right and they will come. And if you build it well and if you can scale it, more and more people will come. So that's the mindset with which we're operating at Ratehub. But I also think the ecosystem is also ready for it. I mean, when was the last time we're struggling to find people to come back to work. And in a similar way, a lot less people are walking into branches compared to, let's say, pre-COVID. So those are some macro trends, consumer behavioral trends that I think we should be cognizant of. And we should adapt how we position products, how we develop new experiences to cater to those needs, attitudes, and behaviors that the consumer is giving signals to us on. And I think the market's ready, personally. So those are learnings that I think we're actually executing on.
Bob, what are you working into your thinking about the economy now that perhaps you weren't a few years ago?
You know, maybe I'll take a bit of a different slant and just sort of say that what's really preoccupying us is the housing supply gap in Canada. Because at CMHC, one of the key things that we care about is housing affordability. We've got a big gap, about 2 million home shortfall right now between what the demand is and the supply. And we think that's going to grow to about 3.5 million by 2030. And so from my perspective, what this means is, as bad as housing affordability is now, it's going to get worse unless we can do something to really increase new home construction. So that's my biggest worry going forward, housing affordability deteriorating for everybody.
Okay, and for the last 30 seconds, Bill, you can go over a little bit if you want. Go to 45 seconds. What's your learning over the last little while?
I'll keep it short. Don't worry. I think the one thing we've learned over the last little while is look behind the headline, right? Bob mentioned it. Per capita numbers are going down. We've had great employment growth. The employment ratio has been dropping quickly. Under 25s, it's actually at a fairly low level. But the headline looks great. And so look behind the headline. And your neighbor may not have the same condition you have. And you may think they will. They're driving the Mercedes. They got 3 cars. But I think what we've learned is you've got to really understand your base and how that's spread out. Don't just assume everything's fine. There's going to be groups in there that are just behaving very differently because they're just strained much more, and you may not see it as a headline. We talked about consumer proposals earlier. I said they were really spiking up. For a lot of those, they've never missed a credit payment. They're not overutilized on their credit cards. They're just going straight to a consumer proposal. You just got to continually segment your base to understand those differences.
Excellent. Thanks, guys. Great discussion.
Thank you so much.
Okay. Thanks, Ken.